Hello, everyone. Welcome to another episode of In Conversation by Advisor Coach. Today in conversation, we thought let's have something which is breaking out the equity clutter. So we have with us Mr. Kaustubh Sule, Senior Fund Manager, Fixed Income with Groww Mutual Fund. Welcome, Kaustubh, to In Conversation with Advisor Coach.
Thanks, Suren. Glad to be here. I hope we have a great conversation.
Yeah, so today, actually, in today's world, everybody's about equity. So it's very interesting, to have you with us today because this conversation is all about fixed income. And we want to bring that as well to our viewers as to fixed income is extremely important too in their portfolio when they do their client allocations, etc. So to begin with, Costa, if you could just give a brief background about yourself and also give a insight into what all fixed income products are available with Groww Mutual Fund.
Yeah, from an educational perspective, I have a computer engineering and MBA finance background. My investment journey started in a bank trading desk during Lehman crisis in 2008. And from there on, both fundamental as well as quantitative aspects shaped my investment framework as well as how I approach the markets, especially fixed income, through macroeconomic as well as quantitative perspective. Before Groww MF, my last stint was with Axis Mutual Fund for 7 years. I looked at fixed income portfolios over there as a fixed income fund manager. And here at Groww MF, we have a suite of products which we believe caters to every aspect of fixed income. We have broadly overnight fund, liquid fund, short duration fund, a dynamic bond fund, and some more funds in the pipeline.
Sure.
This is what we offer to the fixed income investors currently.
Sure. So there are a couple of products which are in the pipeline as we speak on the fixed income side.
Yeah, Guild product is in the pipeline and some more we are working on. I think a lot of developments in past couple of years have ensured attractiveness of fixed income remains in investor portfolios. And I'm sure investors are looking at it from a very different perspective now, given all the global as well as local developments.
Sure. So, Costa, we did see some, couple of months ago, at least 1.5 months ago, that there was a lot of tightness in the systematic liquidity in the overall system. Of course, RBI took a lot of tactical measures and has definitely taken care of that. So there is a good amount of systematic liquidity available now. So could you tell our viewers in terms of what are these tactical measures which RBI has taken? Number one, how do they impact? And do you believe that with the liquidity coming in, the lenders, including the banks, have actually transmitted the drop down in the rates to the market in terms of the borrowers?
Yeah, I think a very pertinent question. We saw liquidity going into deficit because of FI outflows, FDI not coming up to the mark. And this time RBI was very prompt in taking action. And why do I say so from a systemic liquidity perspective? That within these 4 months, right, from the December CRR cut to the OMO announcements in April, if you look at the absolute amount of liquidity that RBI has injected into the system is very nearing the liquidity that RBI injected during COVID crisis in 1 year.
Yes.
So, this quantitative aspect itself signals that RBI has been proactive in ensuring liquidity to the system. And they are very cognizant of the fact that without liquidity, interest rates cuts do not get transmitted. So, the first aspect is, there should be enough liquidity in the system for transactions to take place and interest rates cuts to get transmitted. One more aspect over here in terms of liquidity is that RBI governor himself assured in press conference post RBI policy that they will aim somewhere around 1% of NDTL as liquidity surplus,
Yes.
approximately over there. And that has been very reassuring to the market participants.
What would that number be, Costa?
So that number would be roughly around 2.25 lakh crore uh,
Right.
uh, of liquidity, banking system liquidity here we
Sure.
are talking about. And the emphasis of the RBI governor was on liquidity and rate cut transmission, as well as, the amount of liquidity that has been injected till now. And one more aspect over here is that, we saw during COVID era is that the bottom of the band, which is basically reverse repo, was the operative rate instead of repo rate, because
Yes.
there was lot of excess liquidity in the system. And one more, the potential case that we are also working with, that there is a good possibility that, lower band of that lower of the band will be the operative rate in one of the cases, and RBI is cognizant of that. So net from a liquidity perspective, my sense over here is that RBI has given enough signaling as well as done enough to assure market participants of liquidity. So next aspect comes transmission of rate cuts.
Mm.
So transmission of rate cuts has started happening a bit. We have seen some bit of easing in home loan for home loan borrowers. Of course, fixed income markets have rallied in, because of the liquidity infusion by RBI, and expectation of further RBI dividend also is there in May. So net liquidity surplus is going to be the phenomena going ahead, as RBI governor himself has said in the press conference, as well as the next step is going to be transmission of rate cuts, which I believe will happen
Sure.
uh, in a quicker manner than earlier, because the liquidity is already in place in the system.
Sure. So since the May 2022, we did see RBI cutting the repo rate by 250 basis points. And of course, recently, increasing the repo rate by 250 points. My apologies. Now, we have seen in the past two MPCs that, the RBI has reduced the repo rate by 50 basis. So on a very approximate basis, what is your belief that how much the repo rate cut has been passed on, actually has been transmitted?
So my sense over here is that around in fixed income markets, around 25 to 50 basis points has got transmitted. If you look at various curves, be it a swap curve or government securities
Sure,
curves,
sure,
it will differ. So this is the rough transmission of the rate cuts. And as liquidity seeps into the system, market will keep on discounting rate cuts. And going ahead, my sense over here is that we may see 50 to 75 basis points of rate cuts. So this is broadly the numbers that I am working with. The reason being, first, during, let's say, a slower growth scenario, you have a handle of real rates going down. RBI has come up with a lot of research material that during COVID crisis the real rate should have been roughly 0.8%.
Mm-hmm.
In 24, they came out with a research paper that real rate should have been 1.8%.
Mm-hmm.
With RBI projection that of 4% for FY26 average inflation rate, and their confidence increasing as stated in the monetary policy that they will reach their 4% inflation target on
Yes.
a durable basis. I think that real rate handle is there with RBI, and they will move towards 5% there. And we can roughly assume that in a slower growth scenario, anywhere between 0.5 to 1% will be the real rate over average
Sure.
inflation.
Sure.
And that gives them a lot of space to cut rates. Uh, uh, Commodity prices are under control. Historically, we have seen commodities being the Achilles heel for us,
Mm.
but that was not the case in 2020 crisis, as well as currently. Brent crude assumption of RBI is at around $70
Mm-hmm. Yes.
here, which is a good approximation. And what we are seeing over here is that vis-a-vis other crises, we are seeing remittances as
Oh, yes,
a
absolutely.
very good number.
$124 billion.
Perfect. Perfect. So I mean, rupees to rupee stability, which has been worrying factors at least in 2008, 2013 kind of crisis, which has been mitigated to a lot of extent. And right now, with these tariffs and everything, we have seen some bit of price action in the market, especially
Right.
treasuries, wherein people may look at other avenues than US treasuries to diversify.
Yes, absolutely.
Net net, it gives a very very conducive environment for Indian fixed income markets, and rates to go down from here.
Yeah, absolutely. Absolutely. So you are expecting in this financial year FI at least about 100 basis cut from here, from 6 to move to 5 on the repo rate side. That's what your expectation is.
So
And has this broadly been factored in the markets? Because what I also understand is that when you look at the US tenure and way the tariff situation is going on. Actually, I'm broadening my question for you. Uh, and there is a lot of threat that the way China is holding about $850 billion of U.S. treasuries, and U.S. Treasury used to be like a safe haven earlier, which is not being construed so for obvious reasons of a recession being hit and a bloating US debt to GDP. So questions are that do you believe that Kaustubh here we could see some inflows coming in from the emerging markets into our GBI, number one. And number two, do you believe that there could be a couple of rating actions which the rating agencies could take in downgrading, the sovereign credit ratings of certain countries because there is a recessionary situation which is being felt. And the third part is that do you expect US to actually cut rates because Mr. Trump is really pressurizing on that?
So I will take the questions one by one. So my expectation is that on repo rate front, we should reach 5% to 5 quarter for this financial year.
Sure.
One more aspect which is there is that medium-term fiscal consolidation by the government of India, as highlighted in Union Budget, gives a clear path towards 50% debt to GDP by 2031. And what it says is that now, in earlier crisis, developed market had fiscal deficits lower than,
Mm.
emerging market countries, uh, let's say like India or some other countries. But now here from 2020, the ball game has changed. The developed countries' fiscal deficit is reaching emerging market levels, and
Mm.
fiscal deficit to GDP of India is looking relatively better. And especially with this path, it becomes very, very attractive that India is focusing on macroeconomic stability.
Mm.
So, and coming to your question of tariffs and its impact, and rating actions as well as FII flows. See, what tariffs has done is that, it has clouded the growth outlook. So even if we
Mm.
are seeing a lot of back and forth on tariffs, that some exemptions are there, some exemption are there, or commentary is bit volatile.
Flip flop every day.
Every day. But the direction is quite clear that we are not going back towards a globalized world. So
Right.
now here, what is happening over here is that, US had become the center of capital flows of the globalized world due to its reserve currency. No other
Mhm.
emerging market or even developed market had that privilege. Now, people will look to diversify at least some part of their portfolio towards countries they believe have macroeconomic stability, or are very serious about their growth and
Mm.
not in such a situation as US. I'm not saying a big part of global flows will come, but a big enough part of global flows will come to us. to impact our markets in a positive way. And so GBI index, of course, will be a part of that. We have seen from 2023 flows coming in, and almost for 2024, it was roughly around $16 billion,
That's right.
23, $8 billion. So that index flows will be there, but some active allocation will also start happening because people will look to diversify their portfolios to bigger countries, and they will look at Indian fixed income markets in a positive way, I think, actively. So to diversify themselves. So that will be, I think, a very positive development, which is what the fixed income markets are also thinking about. So, as far as credit rating downgrades are concerned, yes, there can be some credit rating downgrades at sovereign level, depending on how much they are impacted by export tariffs and everything. So, yes, we'll have to look at it from case by case basis, because the situation is evolving.
Mm-hmm.
And so that is really a very evolving situation. And from a rate cuts perspective in US, there are two aspects to it. Department of Government Efficiency, which is led by Mr.
Yeah.
Elon Musk, is really looking forward and taking actions in cutting down government spending. And US government spending is roughly 28% of the GDP, which is huge. And
Yes.
you reduce that
Very
spending,
true.
you will have some impact on growth. And now on top of
It's
that,
about 6 to 7 trillion a year.
yes, so they are having a huge deficit. So
Capital spending.
yes, so that impacts their economy through a slowdown of growth. Second is tariff can muddy the inflation aspect a bit.
Sure.
So net, the situation is evolving, and I believe that we should get 50 basis points to 75 basis points rate cut by Fed this year. And this also helps RBI in taking
Mm.
consideration, because
True.
a dollar is still the reserve currency. So beyond that, we'll have to evaluate in US that what the inflation growth mix pans out there.
Sure.
Unlike India, there are a lot of factors muddying over there. So India has a lot of positives as far as inflation is concerned. And one more aspect that is positive for India is we will see some bit of disinflation exported by
Mm.
China through goods, cheaper goods coming to India. We have to see how this situation evolves.
Right.
But overall, US will see rate cuts, and that situation is evolving currently. We have to
Sure.
tariffs.
Sure. Sure.
Thanks.
Sure. So thanks for those wonderful inputs. So, given the scenario today, what we're going through, what message, you would like to give to the mutual fund distributors, investors, the advisors, specifically on two things. One, on the safety aspect of investing in fixed income, and which subcategory of the product do you believe is a great fund to invest in at this point of time, looking at diversification as well as asset allocation perspective?
Okay, I think the first question about safety and risk, regulator has done an excellent job of categorizing funds in terms of risk through PRC metrics
That's true.
or riskometer, transparency of portfolio. Fixed income portfolios are declared every 15 days on the website of respective
Yes.
AMCs, which is much more transparent. AMCs have internal risk management teams, CRO. So from a safety perspective, for advisors and distributors, there are a lot of risk management tools that can be leveraged, and they know the risk profile of their own investors, which can be mapped one to one to the respective funds from a
True.
riskometer as well as metrics, PRC metrics perspective, in fact, they can build on those tools.
Right.
So you can make your own internal models on those tools. Those are really very good initiatives. And see, transparency means that you have a lot of quantitative data, and from that quantitative data, you can derive your own conclusions and the appropriate portfolio which is required, appropriate fund is which is required,
Sure.
depending on investor risk appetite.
Sure. Sure.
So from current perspective, the appropriate subcategory that we believe is good to take benefit of the rate cuts, as well as medium-term fiscal path by the government and some bit of FII flows coming in because of long-term dollar haven status in question for US. All these three factors, we believe that dynamic or gilt category will be very good for investors from a medium to long-term perspective. And let's say an investor doesn't want to take interest rate risk and is comfortable with some bit of highly rated corporate bonds also. Short duration becomes a very good category in that aspect, because so much of liquidity infusion will result in spread compression of corporate bonds, and that will benefit those funds. So,
Sure.
so these are the two broad subcategories which we believe are good or suited for investor portfolios in this scenario.
Sure. Sure. Thanks for that. So, well, for our viewers, this is Mr. Kaustubh Sule, Senior Fixed Income Fund Manager with Groww Mutual Fund. I think this conversation was much needed because there's so much of noise around equity for the past 4 years that people have completely forgotten that there is another wonderful category called fixed income. So, where, Kaustubh, we requested, and, he was gracious enough to give us some insightful information today on fixed income as to why this asset category is also very important. And with all the noise and the dust going around across the world, why this category is here to perform as well. So, Kaustubh, thank you very, very much for taking our time today and joining us today in Conversation with Advisor Coach. Thank you very much for all your wonderful thoughts.
Thanks, Suren, for the great conversation.
Thank you very much.